How's everybody doing? We are live in the strategy room here on this Saturday night, March 1st, 2025, which is awesome. I am your host, Dr. Joe Berquist, the banker next door, and I hope you welcome you all into our flagship live stream that we do every Saturday night at 8 o'clock here, the strategy room. And we got a great show lined up for tonight. I got all kinds of great stuff to share with everybody here tonight. We're going to go into a bunch of amazing things. I've got all kinds of economic updates. We got some really interesting articles to look at. We're going to take a peek in on what Doge is doing. We're going to look at what interest rates are doing or what they've been doing, like the 10-year treasury and things like that. Number of interesting stories tonight. A couple of very interesting different things going on that I'm going to share with you guys. A lot of banking news, a lot of great things happening in the banking world this week. But I'll tell you what, let's kick it off as usual. I'm going to go in and let's see how our lovely folks at Doge are doing. Check in on our Doge clock here. We're at 152 billion in savings so far. That's pretty good. Pretty good. Not bad for about a month in. 152 billion so far, ticking away on the clock. You love to see it. I'm going to show you guys something else here tonight. I actually was looking at this week. So this is the actual Doge website, and you can find this at doge.gov. But there's a lot of cool things on here. So you could basically follow them on X. But they have all of kind of like their X posts up here that you could kind of scroll through here to see kind of what they're doing and what they're working on. And I did find this website to be very, very transparent. I thought it was really good. So, and they have a number of the navigation at the top here. You have savings, you have spend, workforce, regulations. You could join about, what Doge is doing. But let's go to spend for a second. So you could go to agency spending and you could see, like Department of Health and Human Services. What did they spend in 2019 versus what are they spending right now? And you could go through Department of the Treasury. You can go through every one of these departments and see like what's going on there. You can take a look at revenue sources. A lot of really, really good information on here. You can click on workforce. And basically, I thought this was really good. Meet the U.S. government. You could trace your tax dollars through the bureaucracy. So executive branch, 2.2 million federal employees. As far as the salaries go, you can see kind of like what the median salary is. Like it looks like about, majority of workers are making somewhere in that neighborhood of 60,000 to about, 150,000 or so. And then it obviously goes down the higher up the salary goes. 16,436 subordinate offices. Total wages, $211 billion. And you can also see age groups here, different age groups of people working in the government. And then it goes down here and you can click on cabinet level agencies, large independent agencies, medium independent agencies, and small independent agencies. And then the regulation thing here is really interesting. So when you go into this, it has an unconstitutionality index, 18.5. This is the number of agency rules created by unelected bureaucrats for each law passed by Congress in 2024. So that's pretty crazy. So, and again, this gets into the whole thing why I reported on Chevron doctrine. We had that giant Supreme Court case last year where Chevron doctrine was finally overturned. So I think that a lot of this, you will begin to see this. I believe, again, it's not a cure-all, it's not a fix-all for the problem, but I do believe you will see this go down in years to come because a lot of these rules and things that get put forth by these. See, the thing with the Chevron doctrine was that a federal agency would put out a rule, and there was no way for anyone to challenge that rule. That was the problem. Nobody could challenge it. And now with the Chevron doctrine being overturned, people can at least challenge the rule in court. They could file lawsuits. They could go to court and see at least have a shot at maybe getting the thing overturned, or at the very least maybe getting it changed so that it's just a better rule, works better, enables more people to more easily comply with it, that kind of thing. But but a lot of really good stuff on here. Code of Federal Regulations. Then we have federal regulations by agency. Department of the Treasury, Environmental Protection Agency, Department of Health and Human Services, Department of Agriculture, Department of Labor. It just goes on and on and on. So there's what, 412 federal agencies or something like that. But really cool website. I really give it to them. Very, very simple. Very simple website, very streamlined, but very easy to use, but a lot of very powerful, really good information on here. So I think I give them an A+ on this. And I had to laugh a little bit because I couldn't help but think, I don't know if everybody remembers when basically they passed Obamacare, and then they tried to set up the exchange. The government tried to set up the exchange website, and they spent, I think it was something insane. They spent like $100 million trying to build the website for the exchange, and it never worked. It's just like they spent this insane amount of money on a website, and then I mean they finally got it fixed and got it up and running and everything. But it just boggles the mind, and yet. Here's Doge. They probably, I don't know. I mean, I don't know what they spent a few bucks on this, but I don't know what they probably spend $50,000, $100,000, putting this website together, something like that. But I mean, there's no flash. There's not, there's nothing fancy on here. But again, here, if we go to savings, there's some information on savings, agency efficiency leaderboard right now. Most total savings versus least total savings. Wall of receipts, again, contracts, real estate. So again, just really fantastic information. And this is the first time I'll just say this last thing on this. This is the first time we've ever had a website where you could very easily and very quickly go and find this information. I cannot, I mean, somebody could correct me or put a comment in or something. I don't believe that there's another website out there that you can easily find this type of information in one spot, like have all this information put together in one place that's very easy to find. So like I said, I was looking at this week and I just wanted to make mention of it. So, okay, let's jump in now. I want to talk about, so this is a really interesting story here. This whole, Trump wants to go to Fort Knox. He wants to see if the gold is actually there. And I saw this article here, and I wanted to talk about it because it does a good job of kind of giving the history of what's going on with Fort Knox. Like, why are people so interested in auditing Fort Knox, or at least looking at what's going on in Fort Knox? So this is from the Epoch Times, and this says, Musk signals looking into gold at Fort Knox. Here's what to know. Auditing Fort Knox gold reserves is a several decades overdue, says a sound money advocacy group executive. So Elon Musk says that we should go check it. So looking for the gold at Fort Knox, Musk wrote on social media platform X on February 18th. This gold is the property of the American people. I sure hope it's still there. But I want to scroll down here. So here's what I really want to get into. What is Fort Knox? Okay, so Fort Knox, officially called the U.S. Bullion Depository, was first established in 1918 and named after Major General Henry Knox, the first U.S. Secretary of War. In 1932, it became a permanent military post. 4 years later, the U.S. Bullion Depository associated with Fort Knox was constructed to secure the nation's gold reserves. The first shipment of gold arrived in 1937, transported from the New York Assay Office and the Philadelphia Mint. It is estimated that Fort Knox holds more than 147 million troy ounces, worth approximately $425 billion. Reserves originated from various sources, including the U.S. government buying gold from other countries during World War II, international settlements, and trade and mining. In addition, a large portion of the reserves was confiscated from U.S. citizens in the 1930s. Yes, Roosevelt confiscated the gold from people during the Great Depression. That's a very interesting story. I will definitely have to go over that someday. In April 1933, President Franklin Delano Roosevelt signed an executive order forcing the public to surrender their gold bullion, certifications, and coins to the government. The government paid citizens $20.67 per ounce, though a year later it revalued gold at $35 an ounce as part of the Gold Reserve Act of 1934, generating a profit. Now, so here's what's to understand there. So the government outlawed the holding of gold, and it took almost 40 years. It wasn't until 1974 that people, U.S. citizens, were allowed to own gold again. Like, think about that. 40 years, U.S. citizens were not allowed to own gold. Like that, I mean, it's crazy to think about, but that happened, and it happened for a long time. And the only reason we came off is because we got taken off the gold standard. Now, stay tuned. I got more on that. We're going to talk about that a little bit more in a minute here. So, okay, so demands for Fort Knox audits. For years, there have been calls for the U.S. government to perform a comprehensive audit of Fort Knox. In 2011, then Rep. Ron Paul, for example, hosted a congressional hearing to speak with federal officials about his legislation to audit the inventory gold reserves at Fort Knox and other locations across the country. No one from Congress has been allowed to view the gold at Fort Knox in nearly 40 years, since the 1970s. This information should be published and available to the American people. This gold belongs to the people, especially since much of it was forcibly taken from them in the 1930s, and the government owes it to the people to provide them with the details of these holdings. In 2021, then Rep. Alexander Mooney filed the Gold Reserve Transparency Act, which directs the Government Accountability Office, GAO, to report on U.S. gold reserves every 5 years. The bill proposed a comprehensive audit that includes an accounting of all transactions, such as leases and swaps, involving U.S. gold holdings in Fort Knox and other facilities. H.R. 3526 failed to advance through Congress. Yes, no surprise there. Hold on to this thought for a second here. Now, notice the key words here: leases and swaps, because I'm gonna come back to this in just a second. And a thorough audit of the country's gold reserves, including at Fort Knox, is several decades overdue. J.P. Cortez, executive director of the Sound Money Defense League, a sound money advocacy group, told the Epoch Times, there are legitimate questions about the status of America's gold holdings. He says that in addition to an in-depth physical accounting for U.S. gold reserves, issues surrounding claims to the nation's metal holdings. Have any gold reserves been swapped, pledged, leased, or otherwise entangled in financial transactions? Has any U.S. gold been mobilized by the Bank of International Settlements, the International Monetary Fund, the Fed, or others? Cortez asks. So, and then we get to official accounts. The last comprehensive audit of Fort Knox's gold holdings was completed in September of 1974, 50 years ago. Then Treasury Secretary William H. Simon invited congressional officials to visit the facility and welcome the press to witness the congressional inspection. The mint is clearing away cobwebs and reassuring the public that their gold is intact and safe. For the first time, photographing is being permitted inside the depository, said then Director of the U.S. Mint, Mary Brooks. Critics have questioned the veracity of this audit, with the Sound Money Defense League calling it a peekaboo glance at the gold in fine Hollywood style. The group notes that no gold bar was examined for purity, several numbers were not compared against official records, and the full tally of gold bullion was not counted. Mary T. Engel, former director for GAO's Financial Management and Assurance, told lawmakers in June of 2011 that U.S. gold reserves are frequently published in various financial reports and have therefore been subject to various audit efforts. At the same hearing, former Treasury Inspector General Eric Thornton attempted to assure Congress that the federal government knows everything about its gold reserves. And we know where it is. We know how much it is, Thornton says, and we know that it is there and none of it has been removed. In September of 2024, the U.S. Mint released an account summary of the nation's monetary gold stock, including at Fort Knox. In August 2017, photos and documents were released of then Treasury Secretary Steve Mnuchin leading a $27,000 trip to Fort Knox to view the government's gold stockpile. Other officials, including Senator Mitch McConnell, also attended. Glad gold is safe, Mnuchin wrote on X after his tour. Yeah, and here's the thing. When they did that tour in 1974, because I remember watching videos on this. When they did that tour in 1974, when they said that it was done in true Hollywood style, they're not kidding. They basically opened up a door real quick. I mean, cameras were allowed to go in. I think it was literally for 2 minutes. That was it, 2 minutes. And they showed one little room. They opened the door real quick, and there was a like a cage door, as you would in front of like a cage in front of like a bank. Like you open a bank vault, there's usually a metal cage there. Almost like prison bar cells, if you could think, kind of imagine that. But they open the door, so there's the bar cell there, so you can see the gold sitting behind it. But nobody was allowed to actually inspect anything. They weren't allowed to go in, look at the gold bars. Fort Knox is a pretty big place, and they weren't allowed to like walk through the place. It was just, oh, we're just going to show you this one little room real quick, peekaboo, and so. There was a lot of criticism of this inspection in 1974, and ever since then, nobody has been allowed, at least the public has never been allowed to officially go in and audit and see what's there. Now, is Fort Knox, is it the only place where we retain gold in the U.S.? No, it's not. There was a gold reserve up in West Point in New York. Then they're obviously the biggest gold vaults in the U.S. are at the Federal Reserve in New York, and also at the J.P. Morgan Chase building, which is right across the street from the Federal Reserve building. If anybody's ever seen Die Hard 3, the premise of that movie was basically robbing the Federal Reserve Gold Vault in New York City. So if anybody ever seen that, there's kind of an idea there. But again, I just wanted to read this article. I wanted to print it out there just to give people a little bit of a background. And there's a picture of Fort Knox there, which is in Kentucky, for anybody who doesn't know. But I just wanted to get, I thought this was a great way just to get a little bit more background on what's been going on, why, why there's been this whole thing there around Fort Knox, and why people are basically saying like, oh, what's going on? Why can't we see what's going on there? And this has been, 50 years is a long time. But let me just go back to this leasing and swaps for just a second. So here's my fear, and this is why you need a true and honest audit of Fort Knox and all the gold holdings. So basically, the gold that was there was owned by the U.S. Treasury. But then at some point, the Federal Reserve basically took ownership of that gold. So when they tell you that gold is owned by the Treasury, it's not. It's owned by the Federal Reserve. So it's in the Federal Reserve's gold holdings. Now, I believe that the gold is there. Whether or not we actually own that gold is a whole different story, because like you said, you have to, and a big part of this is you have to understand how the gold market works around the world. You have three main gold exchanges around the world. Yeah, the most famous of which is the London Gold Exchange over in England. You have the gold exchange in New York City, which again, Fed and J.P. Morgan play big parts in that. And then you have the gold exchange with China over in Shanghai, which is the more recent addition in the last 20 years or so. But those are the three big gold markets, and so you have to understand that you have gold contracts, you have gold futures. There's trading on gold. You have gold ETFs. So there are all these derivative contracts, if you will, of gold. So there is and you really won't understand or get the true picture unless you're allowed to audit and get into the Treasury and the Federal Reserve and look at their contracts as it relates to the gold holdings. They could open up the doors and all the gold is there, and you could have people running around saying, oh, hey, see, look at that. All the gold's there. It's fine. Everything's good. See, there was never anything to worry about. Yeah, that's all good until you look at the contracts and you see that basically it's possible that 80 to 90% of that gold has been leased out or is involved in swap contracts or futures contracts, or we have the gold in our physical possession, but we don't necessarily own it. And that's where the devil is always in the details, as they say, like that. And that's really what we need to look at and really what we need to find out. Okay. Now let's go on to, I want to show you guys something else here. Now the one issue I have here is this is a huge chart. And I'm going to have to make it a little bit smaller here. And I apologize if everybody can't really see this too well, but this is an amazing chart to look at. So this is American colonies / United States. This is inflation versus gold from 1665 to 2025. Now, there are three key lines here to keep an eye on. There's the red line, which is the CPI, the Consumer Production Index, which is one of the leading indicators of inflation. So the red line basically is down here toward the bottom. If you could see in the bottom right-hand part of the screen there, where I'm kind of pointing with the arrow there, you can see that red line. So that's supposed to be the headline inflation, if you will. So that's headline inflation. Then the other two lines here, we have an orange line. So this is year-end 2024 gold and 2025 latest. So this is the gold value we have here. This yellow line here is the gold value. And then we have the blue line, which is a little hard to see because it almost lines up perfectly with the gold line. Now, the blue line, this is called Shadow Stats Alternative CPI. And I got this chart from Shadow Stats. Shadow Stats is a great website. If I have shown it in the past on the live stream, but I highly recommend people go and check out this website. It's MIT grad, a gentleman named John Williams, who's an economist, he provides all kinds of alternative economic data, and a lot of the data that he presents will blow your mind, and just like this chart here. So in other words, think about it like this: the red inflation line here at the bottom, that's the headline inflation number. That's what they're telling you inflation is. The blue line is what Shadow Stats is saying the inflation actually is, and I could show you guys something here in a few minutes that will probably blow your minds on X in terms of like the value of people's houses from the 1950s to today. But anyway, you could see here, the point of this chart is that you could see how much the value of gold has shot up. And you could see how much the inflation has kept pace with gold if you're looking at the actual inflation numbers. And that's what's mind-blowing when you look at this chart. Now, a couple of bullet points they have here. In 1914, founding of the Federal Reserve. Then we have 1933, Roosevelt abandoned the gold standard. What did we just told? We talked about the confiscation of gold there in the last article that we just looked at in 1930, and also in 1933. The big key date on this thing, 1971, Nixon closes the gold window for 50 years now. And I've showed charts in the past on national. You look at the national debt from the time that Nixon officially took us off the gold standard. And our national debt over that 50-year period of time just exploded in just like this, like a hockey stick graph, just shooting to the moon. And that's exactly what you see here. Since 1971, since Nixon took us off the gold standard, you see in this chart that the value of gold is shot to the moon, $2,900, and then inflation has gone right along with it, the actual inflation numbers. Now, what's the last bullet point on here? 1980, the CPI reporting alterations started. Notice what they said there, the key word at the end there. This is when the CPI reporting alterations started. Not finished, not changed once. They've changed it about 5 times since 1980. So 45 years, they've changed it about 4 or 5 times in that period of time. And this is why in economic circles, the CPI is called the CP lie, because they have manipulated the numbers over the years to give them the statistics that they want to see. One of my favorite books all time. When I was in college, I had to read a book called How to Lie with Statistics. I'll share that. I'll share that book with everybody one day. It's a little bit. That book's a little bit difficult to present because you have to. I could show you a chart, but then it takes a while. It takes a while to explain it because you got to get into the statistical, mathematical equations, and then you got to get into some of the psychology of it. But like I said, it's a fascinating book. If anybody has a chance, I highly recommend it. The book's called How to Lie with Statistics. Go check it out. You'll love it. You'll find it will, like, the next time you walk into like a Walmart or Target or any retail store, and you start looking at the sales, and if you ever wondered why things were priced at $8.99, $9.95, if you ever, the way that they massage sales, why something is 20% off, why something is 10% off, buy one get one free. Like, if you've ever wondered all these things, or how these things came about, or why they came to be, read that book, How to Lie with Statistics. It explains all that stuff to you. You will never, once you read that book, you'll never walk into a retail store and look at the things the same way. You'll never will, because all this stuff will click as to why this stuff is not, it's not real in a certain respect. It's very much make believe in a very real way. But anyway, I digress. So, but like I said, I wanted to show this chart because this chart is just, it's mind blowing how much the inflation has followed the value of gold. That's the key thing to understand. Inflation has followed the value of gold, and both have gone through the roof. So, but like I said, this is a chart that I got from Shadow Stats. John Williams, I love to giving him a shout out. Great guy. I've actually talked to him on the phone a few times. I had a few questions about some of his things, but he puts out some incredible information. And I will be sharing more of his stuff in the months ahead, because he's got some really great stuff. And I believe that the things that he has are a lot more accurate than a lot of the headline numbers that we see and we get. So, okay, let's take a peek in. Where are some of the treasury yields at right now? So we've got the 30-year T-bill is currently hanging out at 4.5%. The 10-year is down to 4.2%, which is very interesting, because if you look at the chart here, we hit our high here on January 13th of 4.793, and I really thought we were heading toward 5%. I really thought we were gonna test that resistance line at 5%, but it has really backed off since then, dropping down to its low yesterday on Friday of 4.2%, which has again been really, really interesting. I think the auctions, the treasury auctions have been pretty decent last month or so. But again, just knowing where Janet Yellen left us, I like I said, I'm very surprised that we've come down about 40 basis points here on the 10-year note. That's good. That helps. But like I said, I wanted to point it out just because I thought it was interesting, because I did not see that happening. I really thought we were gonna start to really push up on 5%, which we might. It might backtrack here in the next couple months, but we'll see. 2-year notes currently sitting at basically at 4%. 1-year bills are again 4.086. The 6 month is at 4.2, the 3 month is at 4.3, and the 1 month is at 4.3, which is kind of interesting, because that is higher than the 2-year, which would indicate that we've kind of and it's actually higher than the 10-year, which would actually indicate that we have slipped back into a slightly inverted yield curve again, which is kind of interesting. But we'll have to take. I'll tell you what. I'll keep an eye on that. I'm gonna make a note of that, and we'll come back to that next week, and we'll take a little bit more in depth at that. I'll bring up some of the yield curve charts, and we'll take a look at that. But okay. Do I want to go into some? Yeah, I'll tell you what. Let's go into some banking news here for a few minutes, and I'm going to run through some of this stuff real quick here before we get to some of the other articles. So, U.S. community banks report weak loan growth in the fourth quarter of 2024. So, U.S. community banks recorded sluggish loan growth in the fourth quarter of 2024 amid persistent concerns around interest rates. Median sequential loan growth for banks with under $10 billion in total assets was 1.1% in the fourth quarter, according to S&P Global Market Intelligence. Total gross loans and leases stood at $2.466 trillion in the quarter, compared to $2.43 trillion in the linked quarter. Community banks in the Midwest recorded the highest sequential loan growth among U.S. regions at 1.3%, followed by the Southeast at 1.2%. And then we have a lot of, again, very interesting charts here. As they said, so this is kind of like total, total loans. You can see like, Northeast not really doing that hot right now. But let's see here. Commercial loans, you can see, not really a whole lot there, 344 billion. Commercial real estate, 752 total billion. Credit card loans, 18. Automobile loans, 35. Total 1 to 4 family, 645. Multifamily, 182. Loans to NDFIs. It's kind of interesting. Non-depository financial institutions. So at 30 billion. So interesting. So like I said, now here's my prediction though. While loan demand was weak in the fourth quarter, I do believe it's going to pick up in the first quarter of this year. I think myself, other people in the business I've been talking to, a lot of people have seen an uptick in loan demand here so far in the year. Let's just hope that holds. Just hope that holds through the rest of the year. But I think the numbers for the first quarter will be up and will look a lot better. So. Okay, demand deposits drive fourth quarter 2024 growth as funding costs drop. So growth in transaction deposits accelerated in the fourth quarter of 2024 as the Federal Reserve interest rate cuts allowed U.S. banks to reduce funding costs more than asset yields fell. So what does that mean in English? That means that basically banks dropped the amount of interest that they were paying on deposit accounts, i.e. CDs. CDs saw a big drop, dropping down from almost pushing up 5% to coming down to probably 3 or maybe in the low 3s for the most part. So that drop has really helped. Banks also probably have dropped rates across the board in terms of money market, savings accounts, checking accounts, you name it. So that interest rate cuts, which is what banks call funding costs, that came back down a lot faster than what they called the asset yields. In other words, the interest being charged on loans. So that was good. So that basically helped out that helped out banks a little bit more there, and really helped to drive the demand deposits. So we saw demand deposits rose 230 billion or 3.6% sequentially across the industry, compared with an increase of 1.5% in the total quarter of 2024. In the fourth quarter of 2024, deposits increased 213 billion overall, with 106 billion in growth in savings deposits, offset by 122 billion decline in time deposits. So some people moving some of their deposits out of CDs because the rates are dropping, basically. Okay. Inflation pushes record number of U.S. workers to take additional jobs. This is something I've been talking about. When you break down the jobs report, one of the key things that we've seen is that the bulk of the jobs are in part-time jobs. And we're seeing that people have to take 2, 3, sometimes even 4 jobs to make ends meet. It's pretty wild. But now you're finally starting to see articles acknowledging this. For a long time, the media was trying to bury this information, and now it's finally starting to come out. So let's just see here. So persistent high inflation and a relatively robust job market have led more Americans than ever before to work more than one job. There were more than 8.76 million Americans with multiple jobs in January, an increase of nearly 6%, or about 500,000 people from a year earlier, according to U.S. government data. The number of U.S. workers with more than one job has climbed by almost 3.4 million since April of 2020, when employment numbers cratered amid pandemic shutdowns. The rise of workers with more than one job reflects a labor market with employers still struggling to fill millions of open positions and workers looking to counter the rising costs of groceries, rent, and other goods and services. A tight labor market and the rise of flexible work have made it easier to take on multiple jobs, while higher housing and food costs have made it more necessary. The share of U.S. workers with more than one job climbed 5.3% in January, matching the highest rate since before the pandemic, according to the U.S. Bureau of Labor Statistics. At the same time, the number of hours American workers are spending at each of their jobs is declining, falling from a peak of 35 hours per week in April of 2021 to 34.1 hours per week in January, matching the shortest U.S. work week since 2010. We're in a period of structural change in the labor market, said Nella Richardson, chief economist at ADP. A new global workforce survey from ADP Research found that worldwide, 18% of employed workers had 2 jobs and 5% had 3 or more. Very few of these workers, however, took second or third jobs because they were unable to find full-time work. In most cases, this was to cover necessary expenses or save for extra expenses, the survey found. In the U.S., for example, more than half of workers with multiple jobs said they took additional work to cover necessary expenses. Less than 20% said it was because they could not find full-time employment. So let me ask another question here. Why do you think that the peak hours, the hours were falling from 35 hours back to 34 hours? A big part of that is the amount of money that has to be paid to the full-time workers. They do, like, in other words, and overtime. They don't want to, companies are trying not to pay these workers overtime. And the workers are basically saying, okay, I got to work multiple jobs, so maybe I have to even out the number of hours that I'm working to try to make this work. But it really is unnerving when you look at this and you basically see how many people out there in the U.S. right now. Again, and this is why I go back to this false narrative of this being this. It's again, they say it right here in the first sentence: robust job market. I do not believe we have a robust job market. I do not believe that's the case. When you have this many workers, 8.76 million Americans with multiple jobs, and having the number of people taking on multiple jobs climbed 5.3% in just January alone. I keep forgetting today's March 1st, but basically 2 months ago. So it's pretty astounding when like I said, when I first started digging into the jobs reports about 18 months ago, and then every subsequent month thereafter for the last 18 months, I was just astounded by what I saw. I just couldn't believe, all the jobs were going to foreign-born workers. All the people most of the jobs that were created were part-time jobs, and the number of people that had to take on second and third jobs just to make ends meet. It was pretty wild. So all right. So I will definitely continue to keep an eye on this, and we will look more in depth at more of the job reports when they come out to basically figure out what's going on there and try to get everybody more information so that they can get a better overall understanding and view of what exactly is going on in the labor market. So, all right, but let's continue on here. So, bank liquidity and mortgage rates to be impacted if U.S. privatizes Fannie and Freddie. Now, I just did an episode a few weeks ago on the potential for Fannie Mae and Freddie Mac to become privatized. This is a very big thing. This because Fannie and Freddie, for people who were around then, basically got nationalized for the most part during the financial crisis in 07 and 08. And they've been sitting there basically owned by the government ever since. And many people have pushed over the last 16 years to return them to the private market, which is where they should be. But there are, there's implications to that. It's not perfect. But let's see, what does it say here? So it says the prospect of Fannie Mae and Freddie Mac returning to the private sector would have substantial ripple effects on mortgage rates, bank liquidity, and capital ratios. During the financial crisis, the U.S. Treasury Department obtained warrants to purchase majority stakes in the Federal National Mortgage Association, or Fannie Mae, the Federal Home Loan Mortgage Corp, or Freddie Mac. Those warrants expire in 2028. While they could be extended, President Donald Trump's administration could opt to end the conservatorships of the government-sponsored enterprises, GSEs. So again, they bought warrants. Okay, that's a fancy way of saying they got nationalized, okay, meaning the government took them over. That's all you really need to understand. Scott Turner, Secretary of the Department of Housing and Urban Development, reportedly told the Wall Street Journal that privatization of Fannie Mae and Freddie Mac is a priority. One privatization proposal estimates the GSE's value at more than $330 billion, according to the report. Federal lawmakers may be able to glean how the administration plans to move forward during a February 27th Senate Banking, Housing, and Urban Affairs Committee, which was actually just a couple days ago, hearing on the nomination of Bill Pulte, whom President Trump selected to lead the Federal Housing Finance Agency, the regulator that oversees Fannie Mae and Freddie Mac. Reprivatizing the GSEs is on the table because of the sheer amount of money that it could raise for the federal government, said Ed Mills, a managing director and Washington policy analyst at Raymond James and Associates in an interview. However, garnering enough political support for such a move is complicated by the interest rate and housing situation. We're just in an environment right now where affordability is pretty constrained anyway because home prices are so high and mortgage rates are so high. So that is first class BS. I want to say the words, but I had to say BS. This is clean. This is clean. It's a clean show. That's first class BS. Okay. I will tell you point blank. The reason why the federal government does not want to let this go is because they have been using Fannie Mae and Freddie. See, Fannie Mae and Freddie Mac, when all things are going well, they make a ton of money. They make a boatload of money. And the federal government has been using Fannie Mae and Freddie Mac, especially Congress, as their personal piggy bank. They've been taking those profits and they have been allocating them all over the place to their own little pet projects. So Congress they do not want to give this up because that's like their personal slush fund. That you're taking the punch bowl away from them, so to speak. They don't like that. They don't want that. So they're going to tell you all these scary stories about, it'll drive up costs and the rates will go through the roof and it'll ruin the market or whatever. Like, no. They don't want to give up their piggy bank. Okay, that's all you need to know. Okay, and I'm waiting for a politician to come out and tell the truth about this because that's the truth. That's the truth. The truth is they've been using this as their piggy bank for 16 years now. It's their private little slush fund, and they don't want to give it up. So like I said, so they're telling they put out these articles like this to basically try to we should privatize it, but we just can't do it right now. Let's just kick the can down the road till 2028 or whatever. Like, no. This almost happened in Trump's first administration. They almost got this thing privatized, but they basically they just ran out of time. I do believe it's going to happen this time around. And I think when it does happen, it'll be a great thing because it will put a huge chunk of money into the government when these guys get rolled back out and become private companies again or publicly traded companies. And I think it'll be a great thing. It'll be a great thing for the market. It will help the markets, the mortgage markets, to work more efficiently. I do believe it'll be a great thing. So we'll keep an eye on that. We'll see what happens with this. Okay. FDIC to stop disclosing assets of banks on the problem bank list. I thought this was very interesting. So the FDIC will no longer disclose the aggregate assets of banks on its problem bank list due to potentially negative consequences. Now, for anybody who doesn't know, you can go to the FDIC website and you can look at what banks are on their problem bank list. It used to be pretty amazing. I used to look at it all the time back in like 2010, 2011. And I tell you what, it was a pretty interesting thing. Back, I would say all the way until probably about 2016, 2017, maybe. If you needed office furniture, the FDI website was the place to go because you could they had these auctions on the website for basically all of the office furniture that they had taken from all these failed banks. It was really pretty cool. You could buy, like if you needed like a phone system for you could buy a phone system that was like $100,000 phone system, and you could get it for probably $8,000. You could get these. As anybody who knows who does commercial office furniture is very expensive. It's not uncommon for say like a really nice desk could cost $5,000. It's not like the stuff you buy at Staples. Commercial office furniture can get very expensive, but you could buy this stuff. I mean, you could buy a conference room table for a boardroom that would be like a $50,000 table, and you could have bought it there for $2,000. It was pretty crazy, but I digress. But anyway, the point being is that if you want to go see the problem bank list, you can go to the FDIC website. You can check that out. But let's continue here with this for a second. So with the changes in the banking industry over the past 35 years, it has become easy to identify if a large bank is added to the problem bank list. FDIC acting chairman Travis Hill said in a statement, this could lead to negative consequences, such as a disorderly run at a large bank that is experiencing severe financial distress, added to the list and correctly identified by the public, Hill said. Easy identification could also result in supervisors failing to downgrade a large bank in poor condition due to fear that disclosure could spark a bank run or financial instability. Additionally, customers might withdraw funds from a bank incorrectly identified as added to the list, or a large bank downgraded for reasons other than deteriorating financial condition due to misplaced insolvency fears, Hill says. For the reasons stated above, the FDIC is not disclosing total assets on the problem bank list as part of the quarterly banking profile materials, and will not be doing so going forward, returning to the original practice of only disclosing the total number of banks on the list. So, yeah, so basically they just don't want to make it easy for you to track the bank down. So in other words, they had the assets. So in other words, you could figure that out very quickly, right? Like, so let's say they said, oh, this bank is a problem and it has assets of $112 billion. Well, you could very quickly do the math on that and figure out, like, okay, there's only about 50 banks in the US that have assets between 100 billion and 200 billion. And let's narrow that down real quick. How many banks have assets between 100 billion and 150 billion? And you, like I said, you could work back into it where you could get to the point where you would probably get down to a list of probably about 4 or 5 banks. And then you basically do a quick Google search. You look up, do any of these banks have negative news on them? Of course, you're going to find one that's got some negative news on it. Maybe they've been downgraded. Maybe they've got some bad loans. Maybe they fired an executive. Maybe they had a scandal, whatever. But the point being is you could figure out who that problem bank was on the list pretty quickly. So now they're basically just going to tell you, like, oh, okay, we've got X number of banks on the list. So again, I don't know. I've kind of mixed feelings about that. On the one hand, I understand what they're doing with this. On the other hand, I'm kind of like, I believe in full transparency. Full transparency. Put it out. If somebody's got a problem, put it out there on the list, and you let the chips fall where they may. All right, let's continue on here. I got a few more things here to run through with this stuff. So U.S. banks' commercial real estate loan delinquencies rise for the 9th straight quarter in the fourth quarter of 2024. So U.S. banks' delinquency ratio for commercial real estate loans rose for the 9th consecutive quarter in the 3 months ended December 31st, 2024. The ratio was 1.42% during the fourth quarter, up 4 basis points from the earlier. At the same time, U.S. banks' total CRE loans were $3.185 trillion as of year-end 2024, up from $3.180 trillion at September 30th, 2024. So delinquencies on U.S. bank CRE loans for non-owner occupied, non-residential properties decreased sequentially to 2.02% in the fourth quarter. Now, those numbers might sound small, like 1.42% ratio. That might sound small, but you have to understand some of the ratios. So anything above 1% is basically really bad. That's not good. And then you had what are called non-owner occupied, non-residential properties. So that's commercial investment properties. Like, think of like a commercial office building, or a retail strip center, or an industrial building that are all leased out. They're leased out to rent. And the ratio here decreased sequentially to 2.02%, but that's a bad number. That's a bad number. I mean, over 2%, that is actually a huge amount of delinquency in any particular in the industry itself is not good. What you like to see is delinquency ratio under 1%, definitely under 0.50%. If you could basically get it down to 0.5%, that's where, like, things are pretty good, pretty normal. When things creep up to 1%, you know that there's something not quite right in the industry. When they're over 1%, it's not good. So we'll have to keep an eye on this and see how this continues to unfold. Obviously, commercial office space has been the big hot button in the industry. That's what everybody's been looking at. So we'll have to see, what continues to unfold with that. So, okay. Retail investor sentiment turns bearish as stock market rally starts to fizzle. After a historic 2-year bull run in the U.S. stock market, retail investors are showing some signs of fatigue, a signal that equities may be at a near-term peak. Retail sentiment has turned bearish, and cash holdings appear to be limited as the S&P 500 index has begun to stumble. From the start of 2023 to February 19th of 2025, when the index last settled at a record high, the S&P 500 rose more than 60%. That's crazy. From February 20th through February 26th, the index has fallen about 3%. However, on concerns of an economic slowdown and increased volatility surrounding policy changes announced by President Donald Trump's administration. Yes. And again, I would expect this to continue. I think that as things continue to morph and change here, we are going to get some rockiness. I've said before, if anybody's been watching my live streams for the last, probably at least since the beginning of the year, for the last couple of months, I've said this year is going to be a little bit of a topsy-turvy year, like where we got a lot of changeover going on here. And Donald Trump, we'll talk about a little bit later. We're going to talk about the tariffs and stuff that are going to be kicking in here pretty soon, on like Mexico, Canada, and China, and that so these things are going to lead to some turbulence. We got Trump's tax cuts from his first administration are set to expire. Will Congress renew those? Will they add some further tax cuts, like no tax on tips, reducing or taking away tax on Social Security? That's to be determined. We have to see what happens there with some of this stuff. And, so some of this stuff is going to, shake things up a little bit. Okay. So we looked at commercial real estate. Now this is focused more in on multifamily. So U.S. Bank's multifamily delinquency ratio increases for the 6th quarter in a row. So U.S. Bank's multifamily delinquency ratio increased for the 6th consecutive quarter as the sector faced persistent softness. At the end of 2024, fourth quarter, the multifamily delinquency ratio at U.S. Banks was 1.35%, compared with 0.97% a quarter ago and 0.55% a year ago. So the 2024 fourth quarter ratios marked the highest since the second quarter of 2023, when it was 1.53%. Again, anything over 1%, bad. So we've seen an overall decline in delinquency in commercial real estate. Now we're beginning to see a more focused delinquency increase in multifamily. So it's not just office that has issues. We're now beginning to see issues emerge in the multifamily side, the multifamily sector. So we'll have to keep an eye on this. Okay. Average net loss rate falls for the 6 major U.S. credit card issuers in January. So the average net loss rate for the 6 major U.S. credit card issuers fell month over month in January, while delinquencies increased. So this is all credit card debt, and the big six, I call them the big six: JP Morgan Chase, Bank of America, Capital One, Discover, Citigroup, and American Express. Now, we are going to become the big five here shortly, because Capital One and Discover Financial Services are basically finishing up their merger, which is going to happen pretty soon. At least it's looking like it's going to happen pretty soon now. But anyway, the delinquency rate declined 10 basis points. The net charge-off rate declined 10 basis points month over month to 2.19% in January, according to S&P Global, a latest form from what's called the 10D filings. The average net loss rate was up 12 basis points from a year ago period. 3 of the 6 companies, Bank of America, Capital One, and Citi, reported sequential declines in their net loss rates. Citi experienced the largest drop with a 58 basis point month-over-month decrease and a 39 basis point year-over-year decrease, bringing its net loss rate to 2.26% in January. So what did I say? Over 1%? Very bad. So we're seeing delinquency on commercial real estate overall. Delinquency in multifamily. Now we're seeing, an increase in delinquency on credit cards. So the net charge-off rate for Capital One fell for the first time since September of 2024. The McLean, Virginia-based company, reported a net charge-off rate of 2.68% in January, down 29 basis points from the previous month, and the highest value among the 6 card issuers. So that's, again, 2.68%. That is really high for credit card delinquency at Capital One. So definitely have to keep an eye on this. Here, this is really interesting, and I think this is a big deal. U.S. banks set to jump back into the digital asset space as regulatory stance softens. So U.S. banks are expected to surge back into the digital asset space once the federal government establishes clear regulatory guidelines around stable coins and cryptocurrency. Under former President Joe Biden, federal regulators adopted a cautionary stance regarding bank industry engagement with digital assets that led some banks to pull back from the space. Republicans, along with the cryptocurrency industry, have claimed the previous administration's policy was a concerted effort to deter banks from offering crypto-related services. Now that President Donald Trump is back in office with Republican majorities in Congress, however, policymakers in Washington are moving to create a regulatory framework that is more supportive of digital asset activities, which could entice banks to move back into the space, experts said in interviews with S&P Global Market Intelligence. More formalized guidance around digital assets will serve as a trigger for banks to move back into the space, says Chris Daniel, a partner at Paul Hastings, who specializes in payments and cryptocurrency. Similarly, Alston and Bird partner Patrick Hanchy said he expects to see more banks offering loans and custody services to digital asset companies, which have been almost non-existent for the past 4 years. Once there's clarity and what the world is going to look like from a regulatory standpoint, I would expect significantly more participants to jump into the fray for sure. Since Trump took office in January, federal regulators, the White House, and members of Congress from both major political parties have moved quickly to chart out the rules of the road for digital assets. On January 21st, for example, acting FDIC Chairman Travis Hill said the agency will adopt a more open-minded approach to digital assets, and the SEC announced a new task force to develop a regulatory framework for cryptocurrency assets. 2 days later, Trump issued an executive order establishing a new working group to propose regulations around digital assets and consider the creation of a national digital asset stockpile. Okay, a lot to unpack here on this. So, me being a banker for almost 25 years now, I would say I am not crazy about this. And I have a lot of ammunition to basically say why this is a really, really bad idea. First off, stablecoins. All I got to say is Terra USD. Enough said. Okay, if you don't know what Terra USD is, Google it. Google it and go look it up and see how it spectacularly collapsed in 2022 and set off the quote-unquote crypto winter in the crypto industry, which culminated in the failure of FTX at the end of 2022. So anybody who makes the argument that like stable coins are these great things or they're safe, they're secure, whatever, no, they're not. Just stop. Furthermore, we have had there's a number of papers that have come out, whether they be research papers or white papers, what have you, that I have reported on in the last few months in various episodes that I've done on the channel, where I have pointed out the fact that these papers have said that stable coins have the capacity to cause major calamity in the financial services sector if they go bad. Like, in other words, like if you have a Terra USD that collapses, right now, like Tether is the largest stable coin. So if Tether collapses, do you know it could be a nightmare. It just could be an absolute nightmare. So it terrifies me. Now, is there the chance though that a good regulatory framework is put around stable coins in particular or other cryptocurrencies that may address a lot of these potential issues? Yes, there is. Yes, there absolutely is. We could get a good regulatory framework that could help to fix some of this stuff. It could make it at least a little bit safer to work in this space. But again, I don't have an issue with people using or dealing with cryptocurrency. I just think that there should be a separation there. I think banks should do the banking thing. Cryptocurrency should do the crypto. Like, this is why you have Coinbase and you have these other crypto exchanges. Leave it over there. We do not need to commingle the two. And I think that commingling the two, and I don't know, maybe I'm short-sighted. Maybe I'm just risk averse. I don't know. But I've seen enough in my, again, almost 25 years of experience here, after living through a dot-com bubble bursting, a global, real estate crisis, a global meltdown, pandemics, and now this cryptocurrency debacle in 2022. After living through all that stuff, I have learned to be cautionary to a certain degree with new and innovative products that are supposed to be so great and then don't turn out what they think they'd be. And I always say I keep getting back to the same question. What can you do with cryptocurrency? What can you do with it? Can I go down the street? Can I go buy something in Walmart with cryptocurrency right now? Can I go online and shop at, I don't know, can I go on Amazon and buy stuff with cryptocurrency on Amazon? No, no. When the day comes when cryptocurrency has a practical use and you can actually go and I know there's people out there that'll say, oh, no, you're wrong, Joe. You can use crypto. You can buy things with crypto. Yeah, I know. I could go buy a Tesla with cryptocurrency, whatever. I could go get Bitcoin and buy, a Tesla or whatever. But no, I'm talking about practical purposes. Can I go into Walgreens and buy some medicine with crypto? No, I cannot. Like it's so. There's a lot needs to happen there. And look, maybe it does. Maybe they figure it out. Maybe they don't. I don't know. But like I said, this just makes me very very nervous. Now, to be fair, I did not like Joe Biden, his administration. I did not like their approach to cryptocurrency. Their approach was like, all right, we're just going to start suing everybody and anybody for basically no reason. And that just made no sense to me. And they couldn't make up their mind whether it was people at the CFTC. It was like, well, is crypto, is it a currency? Is it a security? What should we treat it as, like a trading asset? Should we treat it as an actual, again, a currency? They kept doing this flip-flop deal back and forth all day long, and they just could not make up their minds, and it was very frustrating. And I will say that not all of the lawsuits that they filed were bad lawsuits. I think so we've seen a whole bunch of lawsuits get dropped against a lot of companies just in the last couple of weeks. And I think that I would say 80 to 90% of those lawsuits were nonsense lawsuits. They were BS lawsuits that should have been brought in the first place. But there were a few of those lawsuits that, I think had some legitimacy and should have continued to be pursued. But again, we'll, like I said, we'll continue to keep an eye on this and see what happens. But I thought that this was, it's a big thing. It's a very big deal. It's a very big deal. And we all need to be looking at it. So, okay. U.S. banks boost net interest margin in the fourth quarter of 2024 as deposit costs plummet. This kind of gets back to, so net interest margin, that's just basically for anybody who doesn't know, that's just the net, that's just the key margin for banks. So like you think of any company is trying to operate on a margin, how much profit can they make? That net interest margin, that determines the profit for most banks out there. So what I talked about, where was the article here? The demand deposit drive in the fourth quarter, basically growth as funding costs drop. That's what basically played into this article here of, U.S. banks boost net interest margin in 2024 because the deposit costs plummeted. So, okay, so we got that. This was interesting. TD Bank. So they've got this asset cap on them now because all the stuff that happened, the $3 billion fine they got hit with all the BSA and AML that they didn't comply with. So basically this says TD adds a credit reserve for tariff damage and updates on U.S. revamp. So TD added an initial $149 million credit reserve overlay to reflect potential damage from U.S. tariffs as it continues to refine its analysis amid a highly uncertain policy and macroeconomic outlook. There is no doubt that tariff and trade risks are clouding the economic outlook. CEO Raymond Chun said during a conference call on first quarter results for the bank. While we have taken initial steps to bolster our reserves for policy and trade uncertainty, the situation remains fluid. Chief Risk Officer Ajay Bambawal said, the bank said many scenarios are possible, including ones that could drive credit provision expenses above its prior guidance of 45 basis points to 55 basis points of average net loans in fiscal 2025. So again, just interesting. They're kind of padding things, and they're padding this credit reserve. So, kind of an interesting thing to see. A lot of crazy stuff been happening with TD Bank, man. They're going to sell their final chunk with Charles Schwab that they owned. They're selling off a bunch of buildings, real estate, other assets that they have, probably going to be selling off some branches, things like that to stay. What they need to do is they need to create room so that they can continue to lend money. If they don't do anything, they're basically going to hit their asset cap and they're not going to be able to lend any more money, which is a huge problem, obviously, for any bank out there. Okay, and this last thing here, pretty big merger news right here. So Seacoast Bank, for anybody who doesn't know, Seacoast Corp is down in Florida. For anybody who may be listening that's down in Florida right now. So Seacoast Banking dubs Heartland Bankshares its cleanest acquisition. So Seacoast Banking Corp of Florida executives praised the borrower base and credit profile of Heartland Bankshares Inc., calling their latest M&A target one of the bank's smoothest acquisitions in terms of regulatory issues. Sebring, Florida-based Heartland Bankshares deposit accounts are primarily a mix of consumers and small businesses, and its loans are locally focused with a conservative, true relationship model. Seacoast CFO Tracy Dexter said in a conference call, the company's loan-to-deposit ratio is 25%, which is amazing. It's amazingly low. That's a fantastic number, which provides for room to move assets into higher yields and grow the combined franchise, Dexter said. So Seacoast has acquired 6 institutions since 2021. Yes, Seacoast has been very active in the M&A of buying a lot of banks down there in the Florida market. But Heartland Bankshares is its first purchase announcement since 2023, according to S&P Global. The company has looked at and passed on a few M&A opportunities in recent years and was focused on pricing and franchise quality when looking for potential targets. So again, just interesting news I wanted to share. So, okay, so now got through all the banking news. Now I have a slew of kind of CNBC and other articles that I want to get into. But before we do that, I have a couple of things I want to get to before that. Okay, so we're about an hour in here, everybody, and anybody who watches the show knows at about this time, this is when I like to talk about a couple key things. First of all, I want to talk about what economic indicators are coming out for this coming week. And then I also like to do a quick recap of the 5 episodes that I put out. So for anybody who doesn't know the format of the channel, I generally put out 5 episodes a week. I put out basically 1 episode every day, Monday through Friday. I usually try to have them come out at noon each day. Episodes are short. They're generally about 10 to 15 minutes in length. Every now and then I get maybe an episode that's like 20 minutes, but I try to keep them short because I want them to be, digestible. I want people to be able to digest them quickly, just watch them real quick and move on to the next thing. And generally what I like to do is I like to cover reports or stories that are just too long to cover in a single segment here on the live stream. I like to some things I like to get a little bit more in depth in, like to provide a little bit more information on. So I like to do that. So, but anyway, but real quick here. So economic indicators coming out this week. So March 3rd, we got manufacturing PMI, we got construction spending, and we got ISM manufacturing PMI. On Tuesday, March 1st, we have the API weekly crude oil stock. On Wednesday, March 5th, we have the ADP non-farm employment change. We have the services PMI, factory orders, and we get the beige book at 2 p.m. On Thursday, March 6th, we get the continuing jobless claims, initial jobless claims, trade balance, non-farm productivity. And then finally, on Friday, March 7th, we get average hourly earnings, non-farm payrolls, unemployment rate, participation rate, and consumer credit. So beige book, obviously a big one on Wednesday, along with the ADP non-farm employment change. But a lot of employment economic indicators coming out this week. Continued jobless claims, initial jobless claims, unemployment rate. So we got a lot of labor market data coming out this week, which will be very interesting to look at. So, okay, now let me run through here real quick. Okay, so what were some of the episodes that I did this last week? So firstly, on Monday, I did episode 327, which was Coinbase, Robinhood, and meme coins. Oh my. And I continued the crypto series. That was episode 16 of the crypto series. And in this episode, I reviewed recent crypto-related stories, including another meme coin disaster, this time in Argentina. Robinhood, the trading app, making big profits off of crypto trading. Are stable coins friends or foe for banks? Kind of continues on the conversation of what I was just going over a few minutes ago. And Coinbase, they basically made some accounting changes and had a legal case dropped by the SEC. So a lot of good, interesting crypto information in that episode. I hope people will go and check that out. On Tuesday, I did episode 328. I did Let's Talk About the Stigma of the Discount Window. So that episode examined a report from the Federal Reserve Bank of New York titled "Can Discount Window Stigma Be Cured?" An Experimental Investigation. So this paper was originally released in May of 2024 of last year. The researchers conducted an experiment to see if forced regular use of the Fed's discount window by banks would eliminate the stigma of banks utilizing a line of credit from the lender of last resort. Does the theory work? Why is there even a stigma to using a line of credit from the Fed? So I had a link to the report in there, but I also had a link to an episode that I did. Episode 216 was an episode that I did called "What is the Discount Window and How Do Banks Get Access?" So if you want to learn a little bit more about the discount window, how banks use it, how they get access to it, go check out episode 216. But if you want to understand a little bit more about the stigma, what is the stigma around banks using the discount window and all you need to understand about the discount window is that it's a line of credit with the Federal Reserve. It's a line of credit that banks get with the Federal Reserve. But why? But the key question is, why is there a stigma around it? So go check out those episodes if you want to get a little bit more information on that. On Wednesday, episode 329, I covered the Federal Reserve's review. I did a review of their Senior Loan Officer Opinion Survey for January of 2025. So this episode examines the Federal Reserve Senior Loan Officer Opinion Survey for 2025. This survey is done to provide qualitative and quantitative information on credit availability and demand, as well as on evolving developments and lending practices in the U.S. loan market. So how is loan demand? What is going on in the current lending market? Those are some of the things that this report seeks to answer. And basically, this is a report that is put out by the Fed basically semi-annually every 6 months, just to get an idea of like what's going on in the lending market. How are things going? What are banks tightening credit? Are they loosening credit? What are they finding? Are they seeing problems with credit quality overall? So it's a good report to look at. On Thursday, I did episode 330. Is your bank ready for the ISO 20022 transition? Gosh, I wish there was a better way to say that. It said that. So I guess I could just say the ISO transition. Is there a bank ready for the ISO transition? So what is the ISO transition? So this episode examines 2 articles related to the ISO. The first is an article from ICBA titled "Countdown to ISO: Key Steps for Community Banks to Ensure a Smooth Fedwire Transition." The second is a blog from PCBB titled "ISO Transition Extended: How to Take Advantage." Both articles review basically what the ISO is, like why banks need to adapt and upgrade their systems, and what the timeline is for implementation. The ISO is a global messaging standard designed to improve payment efficiency, regulatory compliance, and data transparency. So I wanted to report on the ISO because it is a big thing, particularly in the payments space. If anybody, what am I thinking of? So if you use Zelle, do you use PayPal? Do you use like Venmo from PayPal? Do you use Cash App? Like if you use any of those apps, part of what this ISO is trying to improve the payment channels as they were. The messaging, the data, how things get transferred from one bank to another. That's what this ISO is trying to improve. But it's a big thing for a lot of banks in the country, like how to adapt to this thing, how to make it good, how to make the payment channels better, so to speak. So, but it's a little boring. I mean, it's a little bit of a dry topic. It's a little boring. It definitely falls more on the technology side of things, but again, I digress. It's an important thing. I wanted to cover it. I wanted to kind of put this episode out there to just be as kind of a base, if you will, to work off of as more updates come out down the road. So, Okay, now that I beat that to death, let's. The last episode for this week was episode 331, and it was a very interesting article. I thought it was called "Is Data the Key to Enhancing Customer Relationships?" So this episode basically looked at a recent article from Independent Banker magazine titled "Is Data the Key to Enhancing Bank Customer Relationships? How successful are banks at personalization, outreach, and differentiation?" Certain types of data, such as the conversation data from social media, websites, and marketing platforms, may help to answer this question. What other forms of data could also play a significant role in shaping your bank's marketing strategy? So, again, very interesting article on the types of data that banks are looking at, and how do you put that data to work for you? How do you personalize it to basically to help bring in more customers? And then once you've brought those customers in, how can you use that data to enhance the experience and make the products better, enhance the customer experience? So very, like I said, very a little bit more, falls a little bit more on the technology side, but I thought it, again, I thought it was a very interesting episode. And just to run down for a second, so just like some of the other episodes I've put out in the last few weeks, like what types of payments did small businesses use in 2024? Open banking, a discussion with Mickey Marshall from the ICBA. That was a really great interview that I did. Who is collecting your data? A list of consumer reporting companies. You should look that up if you want to know who's collecting your data out there. It's a lot more. It's a lot more companies than you would think. Very, very interesting. I did what is going on with auto repossession. How does the U.S. Treasury feel about AI in financial services? Should you consider investing in tips? If you don't know what tips are, go check that episode out. I talk about, are people in their 50s and 60s better entrepreneurs? I thought that was a cool episode. Got a lot of comments on that episode. A lot of people really like that one. Another episode is starting a small business worth it. I got a lot of comments on that one as well. And then another interview I did was with Alex Blum from Alex Blum Creates. I did Talking TikTok and AI with Alex. So Alex is she's a frequent contributor to the channel. And that was a great interview. If you ever get a chance to check that out. Another great interview. Where was it? This was... episode 316. I did a few episodes. It's called Chaos in Kansas. And this was a conversation with Alan Berkeley, who's another friend of the channel who's come on a number of times. So Chaos in Kansas, it's a longer episode. I would prep you for that. It's about 45 minutes. But I would say this, if you like a great story, you'll love the episode, because basically it talks about this small bank. It was called Heartland Tri-State Bank, which was basically a small bank in Kansas that failed in 2023. And it failed because the CEO got mired in a crypto fraud, which is known as pig butchering. It's what's called a pig butchering scam. And the CEO gets mired in this fraud, and he basically embezzles $45 million from a bank that only had about $115 million in assets. So think about it this way. He almost took like half the assets out of the bank to fund this crypto fraud, or to keep try to keep the crypto scam going, as it were. But it's a fascinating story, because it looks at so many things from so many angles. Like, how is it that somebody who is a 30+ year veteran in the banking business, basically somebody who is an expert at detecting a lot of fraud, how did they get sucked into this kind of fraud? How did they fall for this? And why did they keep it going? How could they not kind of pull themselves out at a certain point? What happens when a bank fails? What does it when a small bank is at the center of a community like that? The ripple effects are amazing. It could damage, and it can do immense damage to a community like that, which is what's happening to this community. The community develops trust issues. Then what about the board? Like, what did the board know? When did they know it? Why didn't they act on this? And the board, oh, by the way, is comprised of, guess what? All small business owners that live and work in the local community. Thus, you understand why the trust issues. So very, very good, very interesting story there. Very entertaining. A lot of twists and turns. I think people, again, it's a longer episode, but it's one I think people would really enjoy. So anyway, okay, I digress. Let's get back to the news now. Okay, so let me jump back in here. So let's jump back in here for a second. Okay, all right, hold on. Need to take a sip for a second here. It's hard doing this live stream for a long time, man. It kills your throat. All right. So let's run through a few more articles here. I've got a little bit longer, got about 20 more minutes here, guys. If you hang with me here, we'll get to the end here tonight. So Trump says Mexico-Canada tariffs will start on March 4th and plus an additional 10% on China. So President Donald Trump said his proposed tariffs on Mexico and Canada will go into effect on March 4th. China, which already faces U.S. tariffs on its products, will be charged an additional 10% tariff on the same date. Trump added in a Truth Social post. The announcement appeared to contradict a timeline laid out about an hour earlier on CNBC Squawk Box by White House National Economic Council Director Kevin Hassett. So President Donald Trump on Thursday said his proposed tariffs on Mexico and Canada will go into effect on March 4th, and that, again, China will be charged an additional 10% tariff. The sweeping 25% tariffs on imports from Mexico and Canada had been paused on February 3rd for 1 month, but the Trump administration has recently sown confusion about whether they would go back into effect when the delays expired. Basically, in a Truth Social post on Thursday, Trump clarified that they would. He said, without providing evidence that illicit drugs are still pouring into our country from Mexico and Canada at very high and unacceptable levels, despite pledges from both U.S. neighbors to boost their efforts to police their borders, we cannot allow this scourge to continue to harm the USA, and therefore, until it stops or is seriously limited, the proposed tariff scheduled to go into effect on March 4th will indeed go into effect as scheduled. He also announced that China, which already faces 10% U.S. tariffs on its product, will likewise be charged an additional 10% tariff on that date. So okay. Here's my thought on this real quick. I do not think that these tariffs on Mexico and Canada will last that long, because I think what Trump is really doing here is I think he's just trying to get these guys to come to the table. The drug issue is a big issue. He wants that to stop, or at least come under a major control. And so I think a lot of this is just to get these guys to come back to the table. That's how I think this is long term. That's how I think this will play out. That's not to say that these tariffs won't go into effect and won't stay there for 6 months to a year. These guys may need to feel, Mexico and Canada may need to feel a little pain before they finally get the hint and come back. Now, China, I could care less about China. I would increase that tariff 50% on China, because it would force people to bring that manufacturing back to the U.S., which is what I want. I want a lot more manufacturing back in the United States. And again, and I don't care about the arguments that people make. Well, companies can't compete, and because U.S. workers make too much money and we have to pay them too much money or whatever. Yeah, tough. Okay, let me tell you something. Drive through West Virginia, drive through Detroit, drive through Ohio, drive through Western Pennsylvania. Okay, there's a reason why these states voted for Trump in 2016. There's a reason why these states voted again for Trump in 2024. They've been gutted. They've been totally gutted. They have stretches, miles of long stretches of defunct commercial properties that used to be great manufacturing plants, where when we were a manufacturing powerhouse going back in the 30s, 40s, 50s, 60s, 70s. So I, again, hey, tariff away on China. I could care less on that one. So, all right. Pending home sales dropped to the lowest level on record in January. Let me say that again. This is a big one. Pending home sales dropped to the lowest level on record in January. So pending sales dropped 4.6% from December to the lowest level since the National Association of Realtors began tracking this metric in 2001. That is incredible. While weather may have been a factor, sales rose month to month in the Northeast. Home prices have been easing over the last few months in certain areas, with more sellers cutting prices, but nationally, they are still higher than they were a year ago. But I mean, this is wild. Pending sales are not just to the lowest level in the last year or so, they're at the lowest level since 2001. They're at the lowest level in 25 years. That's just it's unbelievable. And obviously we know about, it says here, high mortgage rates and elevated home prices combined to crush home sales in January. Yes, we know that. Pending sales. While weather may have been a factor, sales rose month to month in the Northeast and fell in the West, which would have seen the smallest impact of cold temperatures. Sales fell hardest in the South, which had been the most active region for home sales in recent years. Mortgage rates were also higher in January. The average rate on the popular 30-year fixed rate loan spent the first half of December below 7%, but then began rising. It was solidly above 7% for all of January. Home prices have been easing over the last few months in certain areas, with more sellers cutting prices, but nationally they are still higher than they were a year ago. So this is incredible. And again, I hate to say it, but there's not really going to be much relief on the horizon. Unfortunately, rates are they're not going to come down that much in the next for basically for the rest of the year. It's not like we're going to see rates, they're hovering around 7%. We're not going to see them drop down to say 5%. I really don't see that on the horizon this year. But hopefully we get more. What we need is more inventory on the market. If we can get more inventory on the market, that will then begin to bring the price of homes down a little bit. Even if it's just a little bit, it'll help. But more on that. So, okay. A couple more economic indicators here. So the Fed's favorite core inflation measure hits 2.6% in January as expected. So what is that? What is that favorite measure? That is what's called the PCE. So the Personal Consumption Expenditures Price Index, the PCE, the Federal Reserve's preferred inflation measure, increased 0.3% for the month and showed a 2.5% annual rate, which again, well above that 2% goal for the Fed. Excluding food and energy, core PCE also rose 0.3% for the month and was at 2.6% annually. Fed officials more closely follow the core measure as a better indicator of long-term trends. Personal income posted rose 0.9% against expectations for a 0.4% increase. However, the higher incomes did not translate into spending, which decreased 0.2% versus the forecast for a 0.1% gain. So what should we take away from this? The point being is that inflation is still well over 2%. We have seen, while this came in as expected, when you look at the other inflation indicators, when you look at the CPI, when you look at the PPI, they have been rising for the last 3-4 months. And the core CPI and the core PPI have been well over 3%. So nowhere near what the Fed is looking at right now. And I think that's what you have to keep in mind here with inflation. February consumer confidence posted its biggest drop since 2021 and latest sign of slowing economy. So the Conference Board's Consumer Confidence Index slipped to 98.3 for the month, down nearly 7% and below the Dow Jones forecast for 102.3. It was the largest monthly drop since August of 2021. The expectation index tumbled 9.3 points to a 72.9 reading, the first time since June of 2024 that the measure has fallen below the level consistent with recession. So consumers grew more pessimistic about the economic outlook in February as worries brewed about a slowing economy and rising inflation, the Conference Board reported Tuesday. The board's Consumer Confidence Index slipped to 98.3. We got that. So views of current labor market conditions weakened. Consumers became pessimistic about future business conditions and less optimistic about future income. Yes. So again, we have to keep an eye on this. So as inflation remains high, labor market remains weak, consumer confidence is starting to drop here a little bit. So I have to keep an eye on that. Weekly jobless claims jumped to 242,000, more than expected in the latest sign of economic softening. So again, weakening of the labor market. So jobless claims for the week ended February 22nd total a seasonally adjusted for 242,000, up 22,000 from the previous week's revised level and higher than the Dow Jones estimate for 225,000. In Washington, D.C., new claims totaled 2,047. Yes, if you've been following the news, you totally understand that. Doge is hard at work. Let's see here, an increase of 421 or 26%, the largest number for the city since March 25th of 2023. In other economic news, orders for durable goods such as aircraft, appliances, and computers unexpectedly jumped 3.1% in January. So I don't know if anybody saw the there was a post going around on social media this last week of like the number of houses up for sale in the Washington D.C. area, and it's wild. If you could go find that post, if you can Google it, look it up on X or Facebook or whatever, it's wild. I mean the number of houses for sale in the D.C. area just had like exploded. And then they had another funny kind of meme. There are certain searches that people in DC have been doing on Google as of late. That's if you want an entertaining few minutes, go look that stuff up. It's pretty funny. So okay, the Atlanta Federal Reserve, they track GDP, gross domestic product, and they put forward what's called the GDP now. So in the first quarter, we're basically on track for negative GDP growth. Atlanta Fed indicator says. So the Atlanta Fed's GDP Now tracker of income data is indicating that gross domestic product is on pace to shrink to 1.5% for the first quarter. While the tracker is volatile through the quarter and typically becomes more reliable much later in the quarter, it does coincide with some other indicators showing a growth slowdown. So early economic data for the first quarter of 2025 is pointing toward negative growth, according to a Federal Reserve Bank of Atlanta measure. So the central bank's GDP Now tracker of incoming metrics is indicating that gross domestic product is on pace to shrink by 1.5% for the January through March period, according to an updated post Friday morning. Fresh indicators show that consumers spent less than expected during the inclement January weather, and exports were weak, which led to the downgrade prior to Friday's consumer spending report. GDP Now had been indicating growth of 2.3% for the quarter. While the tracker is volatile and typically becomes a more reliable measure much later in the quarter, it does coincide with some other measures that are showing a growth slowdown. This is sobering, notwithstanding the inherent volatility of the very high frequency nowcast maintained by the Atlanta Fed. All right, so here's my take on this. I am not surprised by this one bit. I would not be. Remember, if we go negative, that would indicate that we're basically going into a recessionary period, right? So we have to be. So again, we have to keep a very close eye on this. I have been saying for over a year now that I thought that the GDP numbers were BS. A lot of this growth that was out there, 3% growth and 2.8% growth. I thought, when you really, again, it's just like the jobs report. When you really dig into these numbers, you see that the headline number looks good. When you look behind, when you peek behind the apron, not looking so hot. So again, I am not shocked by this one bit. And like I said, we'll have to keep an eye on this and see what goes on. I will certainly report more on this as it comes down the pike here. So, okay. Bitcoin turns positive, but still heads for its worst week since 2022 FTX collapse. So Bitcoin turned positive on Friday after the latest personal consumption expenditures price index came in line with expectations after falling below the $80,000 level overnight for the first time in 3 months. The price of Bitcoin was last higher by 1% to about a little over 84,000. So here's an interesting little chart here on Bitcoin. So basically we had the high here on February 3rd. We had hit the high of just over 100,000 value for Bitcoin, about 101,000, and that plunged down to 80% here just a couple of days ago, and now popped back up to about 85,600. So Bitcoin definitely coming back down off of its high. So we'll have to continue to keep an eye on this and see if it continues to fall any more than that. Okay, this is interesting. So Trump's proposed gold card visa comes with a hidden tax break for the wealthy. So President Donald Trump's proposed 5 million gold card for U.S. residents would be one of the most expensive in the world, according to experts. It also includes a tax loophole that would give the new card holders a lucrative benefit not available to American citizens. Trump said gold card holders would not be subject to taxes on their overseas income. So, President Donald Trump's proposed 5 million gold card for U.S. residency would be one of the most expensive in the world, according to experts. Yet it also includes a tax loophole that would give the new card holders a lucrative benefit not available to American citizens. Trump this week announced the creation of a new investment visa that gives the overseas wealthy permanent residency and a path to citizenship in return for $5 million. Attorneys who advise the wealthy on migration and investment visas say demand is already strong. The introduction of the gold card visa program represents a unique opportunity for high net worth individuals looking to secure U.S. residence with a pathway to citizenship. Notice they do not become citizens. They just get a residency and they get a pathway to citizenship. So it's not like you pay the $5 million and you get the citizenship. It's not like that. And I think I love there's an interesting chart here. So high net worth individuals moving to new countries, 2013 to 2025. The number of millionaires moving across borders in 2025 is predicted to continue at record levels. So you can see, obviously, it dropped off during the pandemic, but yet 120,000 in 23, 128,000 in 24, and projected 135,000 in 2025. But I saw the press conference on this, and what was interesting about this was they said that basically all of the money raised from this will be put toward paying down the national debt, which I think is awesome. And I guess they crunched the numbers and they basically said something like if 1 million people sign up for this, it will raise $1 trillion that will be put toward paying down the national debt. Now, does that create a huge dent in the national debt? Being at the fact that we're sitting at $36 trillion here in national debt? No, it doesn't. It doesn't really make a dent, but it's something. It's something, and it's something, and it helps. I like the program, and again, this kind of this drawback of like, oh well, the people who come here, they won't be subject to taxes on their overseas income. Well, okay, well you got to give them, if you want them to pay $5 million, you got to give them a pretty sweet incentive to do that. So again, I don't mind that trade-off if in fact the money is going to be taken and is going to be used to pay down the national debt, and they do in fact think that they could get 1 million super high, super wealthy individuals from around the world to buy into this thing. I love it. I love all that. And I will also say that I love the thought process behind it. Like, in other words, the U.S. is like this premium market, and why should anybody from outside get basically access to this market for free? It's like basically paying a toll to come in here and get access to the market. Like, in other words, if you want to go to the NBA game, you got to buy a ticket. If you want to go to the NFL game, you want to go to the Super Bowl, you got to buy a ticket. And I look at it the same way. Hey, look, you want to come foreign, you want to come to the U.S., you want to maybe get a potential path to citizenship, and you're super wealthy, you're stupid rich, basically, then yeah, pay the $5 million toll, get this gold card, and come on in and do business. So I really like it. I think it could be a great thing. It could be a great idea, but we'll have to see how that plays out. All right, I'm not going to get into this because we're coming to the end here, guys. I was hoping to have a little bit more time to get into this. This was a really interesting article called How Private Equity Played a Role in Red Lobster and TGI Friday's Bankruptcy. So I'll probably have to save this one for next week, but it's really interesting, what private equity does to these companies when they take them over. So we'll like I said, we'll save this one. We'll get into it next week. A couple other things I had here. What would Trump have to do to defeat inflation? Maybe nothing. Interesting article. Like I said, I'll probably come back to that one next week. Robinhood says it won't face SEC penalties over its crypto business. good for them. Like I said, I've been kind of following Robinhood and some of the things that they've been doing. Obviously, they've really gotten into crypto trading here, so seems like they'll be all right. SBA to overhaul loan programs and collections under new administration. So we'll get into that more next week. Office valuations drop again as market has yet to find a bottom. Yep, more to come on that. This is an interesting one. Real estate agent numbers plummet to decade low as industry undergoes transformation. I'll have to talk about this one next week in a little bit more in depth because this is an interesting story. And I believe it or not, I think this is actually a great thing for the real estate industry, and I'll explain more on that next week. This was a good article from the Wall Street Journal. What do mass federal layoffs mean for the labor market? And then last thing here, big banks are scrubbing their public mentions of DEI efforts. Yeah, we'll have to get into a more in-depth conversation about DEI. There's a lot going on with this right now. A lot of companies really backing off of this, which I think is a great thing. But like I said, I digress. We'll kind of get back into that next week. So okay, so I've started this new thing where I like to end with a story, and I have a kind of a quote of the week that I end with. So let me pull this up here. So what's our little story here for tonight as we wrap up? So the crisis of 1792. Now, if everybody remembers, the United States had just won the Revolutionary War. George Washington was elected president in 1789. We basically instituted the first central bank of the United States, which was called the Bank of the United States. That was instituted with a charter in 1791. So this is coming a year after that, as our financial system kind of just got on its feet. So Wall Street had its first major crash in history on what was called Black Monday, as Treasury bonds lost 10% of their value, and shares in the Bank of the United States, which again was America's first central bank, chartered in 1791, dropped 12%. Prior to the financial crisis of 1792, the Bank of the United States overexpanded its credit creation, which led to a speculative rise in the securities market. When a number of speculators ultimately defaulted on their loans, it set off panic selling of securities. In response, then Secretary of the Treasury Alexander Hamilton cajoled many banks into granting discounts to those in need of credit in multiple cities, in addition to utilizing numerous policies and other measures to stabilize U.S. markets. So very interesting. So the first major market crash in U.S. history coming in 1792 and was called Black Monday. Now, we had another Black Monday in 1986, which I'll talk more about that on another date, another time. So, okay. Now, what is our quote of the week here? So, the best executive is one who has sense enough to pick good people to do what he wants done, and self-restraint enough to keep from meddling with them while they do it. And that was from President Theodore Roosevelt. So great quote from him. So thank you so much for joining me tonight. I'll kind of wrap up by saying, if you really liked what you saw here, please make sure to like, share, and subscribe. That really helps the channel. I'm really trying to make a run to 1,000 subscribers here. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to people. And so again, I thank everybody so much for listening. Make sure, like I said, new episodes come out Monday through Friday, during the week at 12 o'clock. They're usually short in nature, so hopefully everybody checks them out and loves it. And I will be back next week, for another, we'll be back in the strategy room, next Saturday night at 8 o'clock. But until then, everybody have a great weekend. Enjoy the week, and I'll see everybody again real soon. Thanks a lot, everybody.